Today, the China syndrome. Hello again, it's Martin North from Digital Finance Analytics, world latest post covering finance and property news. Well, China slid into deflation in July, adding pressure on policymakers to step up monetary and fiscal support, even as signs that the decline in prices is temporary and that may limit any stimulus. The consumer price index dropped 0.3% last month from a year earlier, according to the National Bureau of Statistics, marking its first decline since February 2021. People had been expecting some sort of decline, but it was hard to take when it arrived. Producer prices fell for the 10th consecutive month, contracting 4.4% in July from a year earlier, which was slightly worse than expected. It's actually the first time since November 2020 that both consumer and producer prices registered contractions. The Statistics Bureau attributed the decline in consumer prices to the high base of comparison with last year, saying the contraction is likely to be temporary and consumer demand continued to improve in July. It is the base effects. With the impact of a high base from last year gradually fading, the CPI is likely to rebound gradually, said Don Lijuan, chief statistician at the MBS, and that's a rare additional comment to accompany the official data. Chinese authorities have recently sought to prevent economists from discussing deflation in a bid to promote positive narratives about the economy. In fact, China is experiencing a rare period of falling prices as consumer and business demand weakens after an initial burst in the first quarter following the end of pandemic restrictions. A prolonged property market slump, plunging demand for exports, and subdued consumer spending are indeed weighing on the economy's recovery. China is in deflation for sure, said Robin Xing, chief China economist at Morgan Stanley. The question is how long? It's up to the policymakers. Will they react with coordinated fiscal and monetary easing? Investors are betting the weak inflation data will indeed prompt the People's Bank of China to add more monetary stimulus like cutting interest rates. However, the central bank is facing several constraints that makes it cautious, such as the weakening yuan and elevated debt levels in the economy. Fiscal support has also been moderate given the financial pressures many local governments are facing. They need to accelerate all the government spending, raise government debt, and do coordinated monetary and fiscal easing to break this debt deflation trap, Xing said. Another thing holding authorities back from further policy loosening are fears about whether the money released into the banking system by the PBOC would be stuck there rather than used to fund productive activity. Some companies are reluctant to expand production as their expectations about profits soften, the Economic Daily wrote in a front-page article on Wednesday. The newspaper, by the way, is affiliated with the State Council China's cabinet. That weak demand for financing among those firms drove them to put loans obtained immediately into deposits. According to the article, liquidity is flush in the financial system. So Beijing has tried to downplay the risk of deflation in the economy, and some Chinese-based analysts say that they were instructed by regulators and their companies not to discuss the matter publicly. PBOC officials said last week that China will avoid deflation in the second half of the year, with consumer price growth likely to trend closer to 1% by the end of the year. Falling prices also suggest real financing costs in the economy are going up, with some economists arguing that should add to the urgency for the PBOC to take action to prevent growth momentum from further weakening. CPI and PPI both dropping into negative territory in the short term has in fact lifted real interest rates, Bruce Pang, head of research and chief economist for Greater China at Jones Lang LaSalle, said. There's a greater necessity to cut the RRR than interest rates in the short term, as there's still room for various structural monetary policy tools and policy bank financing tools, he said, referring to the amount of cash that banks are required to keep in reserve. The core inflation measure, which excludes volatile food and energy costs, did pick up to 0.8% from 0.4%, which is a sign of underlying, although subdued, demand in the economy. And a breakdown of the consumer inflation figures showed that prices for household goods, Food and transport contracted, while prices for services, spending like recreation and education climbed. So we expect CPI to be negative only for a short term, like 1 or 2 months, said Ding Shang, chief economist for Greater China and North Asia at Standard Chartered. Food and energy prices are more likely to go up instead of going down in the second half of the year. That means the drag on CPI seen in the first half from food and fuel will likely ease. And while PPI has likely bottomed, it will be rather hard to emerge from deflation in the rest of the year, he said. Using the gross domestic product deflator, that's a measure of economy-wide prices, China was in deflation for the first time in the year. And by the way, the International Monetary Fund defines deflation as a sustained decline in an aggregate measure of prices, such as the CPI or the GDP deflator. Unlike the temporary drop in consumer prices of late 2020 and early 2021, driven by falling pork prices, the contraction this time around is driven by more longer-term factors, such as falling external demand and the property downturn. With export prices falling, China is set to pass on deflationary pressure to other countries via its massive goods trade. But it could be that China decides to wait out those declines rather than moving towards bigger support for the property sector, and hoping, of course, for some internal demand for Chinese goods to pick up and that inflation will be tamed. And that said, the longer-term demographic shifts in the second largest economy will continue to pressurize growth, and that means that momentum could remain weak. And this has consequences for the world economy, not just China. Of course, what they're hoping is that as inflation is beat in Western economies, demand for Chinese goods will rise. We will have to wait and see. It is quite a syndrome. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.